What if I told you the US elections are already influencing your money, even when you're not thinking about them yet? Because the market doesn't wait for the media calendar, guys. Hey everyone, Chad here from Zero Markets again. Now every week, I bring you insights on markets, on investing, and trading for those who want to operate with strategy and intelligence without getting caught off guard. Maybe you're not following the US elections yet. Maybe they don't hit your radar until September or October when all the political news takes over. But your portfolio, it's already reacting. Today, I want to show you 4 historical patterns that tend to occur in the US midterm election years, and more importantly, what that means in practical terms for your investment strategy. No political drama, no party bias, just data, market behavior, and smart decision making. Point 1, the stalled market before the vote. There's a pattern that many investors often overlook. November, the election month itself, isn't statistically different from other months. What changes is the 12-month period leading up to the US elections. Historically, the main US index tends to post more modest gains during that stretch. Not necessarily negative, but definitely weak. And that creates the feeling many investors describe. It feels like the market isn't going anywhere. And that happens because investors hate uncertainty. During US elections, the political backdrop raises questions about taxes, government spending, regulation, fiscal policy, and when the future isn't clear, conviction drops and capital becomes way more cautious. Point 2, volatility increases. Even when returns aren't negative, the path is usually more turbulent. Bigger swings mean more noise, and more noise leads to impulsive decisions. You see, in this environment, investors tend to sell at the worst possible time. They tend to cut exposure too early, and they rotate into defensive sectors after they've already rallied. Pre-election volatility doesn't destroy wealth. Emotional decisions do. I'm going to repeat that. Pre-election volatility does not destroy wealth. Emotional decisions do. And here's something important. By the time election risk becomes a headline, much of that risk is already priced in. The market moves ahead of the narrative, always. Point number 3, after the outcome, the market breathes. Now here's the interesting part. Historically, the one-year period following midterm elections has tended to deliver above average returns. Why? Because uncertainty declines. It doesn't necessarily matter which party wins. What matters is that the political fog clears. And when that happens, the market shifts its focus back to what truly drives performance: earnings, growth, inflation, global liquidity. US elections pass, fundamentals remain. Point number 4, a divided Congress isn't necessarily bad. Since World War II, it's been common for the president's party to lose seats in Congress during the midterms. The result, often a divided Congress. And interestingly, the market tends to interpret that with relative calm. Why? Because divided government reduces the probability of sweeping changes, fewer abrupt reforms, more predictability. And predictability is something markets value. What does this mean for your portfolio? Now let's move from theory to practice. Instead of trying to predict who will win the US elections, maybe the smarter question is my portfolio built to navigate periods of uncertainty? Here are a few strategic points. Number 1, discipline beats prediction. If your allocation aligns with your time horizon and your risk tolerance, drastic changes rarely help. Historically, trying to front-run election reactions does not pay off. Number 2, geographic diversification matters. If your portfolio is heavily concentrated in the US, then you're more exposed to domestic political narratives. Adding exposure to other developed or emerging economies can reduce that dependency. This isn't about leaving the US, it's about not relying on a single engine. Number 3, strategic liquidity. Volatility creates opportunity, but only for those with cash available. Deciding in advance which assets you like to buy and under what conditions helps prevent emotional decisions in the middle of chaos. Number 4, separate narratives from fundamentals. Political theater is loud, but not every speech changes corporate earnings, discount rates, interest rate trajectory, growth structure. Learning to separate narrative from structure is what sets strategic investors apart. You might not be thinking about the US elections yet, but your portfolio should be prepared for them. Not to predict the outcome, but to navigate the process intelligently. Because in the end, elections pass. Well-built strategies remain. If this video helped you see the landscape more clearly, here at Zero Markets, we go deeper into this kind of strategic analysis, less headline and more structure. If you want to invest with less noise and more clarity, follow us and keep sharpening your market perspective. I'll see you in the next video.